MCX IPF presents Simplifying Commodities, Futures, Options and Indices.
Commodities can be traded or hedged by ways of future and options. So let's understand how these two instruments work and also the advantages of options trading. Futures are fungible contracts, an agreement between buyer and seller of a commodity on a forward date at a predetermined price. Now, traders often get involved in futures contracts to hedge against asset price changes. Options, meanwhile, are financial contracts but not obligatory. Options offer versatility and are even used for forming various trading strategies. Futures are easier to understand and traded in a structured and deep market, which adds to liquidity. So what are the advantages of the commodity trade options contracts? Since commodity option contract buyers pay a premium for these contracts, they are not required to maintain mark-to-market margins. In futures, though, the stakes are way higher as they involve compulsory delivery. Options work out cheaper than futures contracts in terms of returns and risk mitigation, as one only has to pay the premium. The major differences between futures and options are that in futures, buyer is obligated to honor the contract, while in options, there is no obligation. But in both the cases, seller is obligated to sell if buyer exercises the right. Futures require higher margin to trade as compared to options. While futures are preferred by speculators and arbitrageurs, options are more used by hedgers. There is unlimited profit and loss potential in futures, while in options it is unlimited profit while the loss potentially is limited. In futures, trade current market price is determined by the current market prices, but in options, the futures prices are specified in the contract itself. Here, the futures prices of commodities can fall to zero, but not in case of options. Price movement in futures is less volatile, but the price fluctuation in options can be really sharp. Let's focus now on three key advantages of trading options. There is cost efficiency due to high leverage, as it requires less financial commitment than other trading instruments. It also offers high return potential for the same amount spent in other trading alternatives. Also, there are more strategic alternatives here on the trading front. Options are more flexible and many synthetic strategies or positions can be created for all market types.
MCX IPF presents Simplifying Commodities, Futures, Options and Indices.
Brought to you by MCX IPF.